NISM-Series-XII Securities Markets Foundation. Securities Markets Foundation. Welcome to this overview of the NISM-Series-XII Certification Course, Securities Markets Foundation. This program is designed to give you a comprehensive understanding of the Indian securities market, from its basic structure to the products and mechanisms that drive it. Course architecture. The course is broken down into 4 core modules. We begin with Module 1, Markets, covering the financial ecosystem and regulatory structure. Module 2, Assets, dives into the features and risks of equity, debt, and derivatives. Module 3, Primary, focuses on how capital is initially raised through IPOs and FPOs. Finally, Module 4, Secondary, explores the complex world of trading, settlement, and investor protection. Market ecosystem, market fundamentals. At the heart of the system is the division between the primary market, where new assets are created, and the secondary market, where existing assets gain liquidity. This entire ecosystem is overseen by key regulators like SEBI, which guards investor interests and regulates the exchanges, and the RBI, which controls money markets and government debt. Equity capital. Equity capital signifies ownership. As an owner, your returns are variable, derived from dividends and capital appreciation. Crucially, equity holds a residual claim, meaning shareholders are the last in line to be paid if the company is liquidated. We use metrics like the price earnings (PE) ratio and the price to book value (PBV) to analyze if a stock's market price reflects its true intrinsic value. Debt securities. In contrast, debt represents lending. It offers a fixed tenor and a fixed coupon, carrying a higher priority claim than equity. The main measure of return is the yield to maturity, or YTM, which moves inversely to the bond's price. Key instruments include risk-free government securities, G-Secs, and short-term debt like T-bills found in the money market. Derivatives market. Derivatives are powerful tools whose value is derived from an underlying asset, used primarily for managing risk. Forwards are customized, over-the-counter contracts. Futures are their standardized, exchange-traded counterparts, guaranteed by a clearing house. Options give the holder the right, but not the obligation, to buy or sell, while swaps involve exchanging periodic cash flows, such as converting fixed to floating interest rates. Primary market issuance. In the primary market, the 2 main methods for raising public funds are the IPO, the first offer, and the FPO, subsequent offers. Pricing can be done through a fixed price method or through book building, where the market discovers the final price via competitive bidding. Crucially, applications must be made using ASPA, which blocks the application money until allotment. Secondary market structure. The secondary market depends on 3 critical pillars. Stock exchanges, MIIs, provide the trading platform. The clearing corporation acts as the central counterparty, guaranteeing settlement and eliminating risk, and depositories hold securities electronically to facilitate seamless transfer of ownership. Trading and settlement. Trading is instantaneous, screen-based, and uses orders like limit or stop loss. Following a trade, the market operates on a T+1 rolling settlement cycle, meaning funds and securities are settled the next business day. Risk is managed by collecting upfront margins, like VaR and ELM, to cover potential defaults before settlement. Mutual funds. Mutual funds offer professional management and instant diversification by pooling investor money. The value of a fund unit is tracked daily via the net asset value, NAV. Funds are categorized by asset allocation, including growth-focused equity schemes, income-focused debt schemes, and hybrid combinations. MF operations and benefits. Mutual funds offer convenient systematic transactions. The Systematic Investment Plan, SIP, allows periodic investing, benefiting from rupee cost averaging. The Systematic Withdrawal Plan, SWP, allows periodic redemption for income. The overall benefits include professional management, superior diversification, high liquidity, and tax efficiency. Conclusion. This concludes our overview of the Securities Markets Foundation course. Remember the NISM examination structure: 100 questions to be completed in 2 hours, with no negative marking. A thorough grasp of these fundamental concepts will ensure you are well prepared for your certification. Thank you.